What if you could buy a $100 stock for just $50, knowing it's poised to soar? That's the thrill of value investing, finding hidden gems the market's sleeping on. Ready to uncover stocks that could change your financial future? Value investing is like hunting for bargains at a thrift store, but instead of vintage jackets, you're after stocks priced below their true worth. It's about buying companies with strong fundamentals. Think solid earnings, steady cash flow, or valuable assets that the market has undervalued due to temporary setbacks or oversight. The goal? Hold these stocks until their price catches up to their intrinsic value, reaping the rewards. Imagine Lisa, a 32-year-old graphic designer who's saved $5,000 to invest. She doesn't have time to track every market tick, but she's drawn to value investing's logic. Buy low, sell high based on research, not hype. Pioneered by legends like Benjamin Graham and Warren Buffett, this strategy bets on companies the market ignores, like a diamond buried in a pile of coal. Why does it work? Markets are emotional. Fear or boredom can tank a stock's price, even if the company's humming along. Data backs this. A 2020 study by S&P Global showed value stocks outperformed growth stocks over long periods, averaging 12% annual returns from 1975 to 2020. Low price-to-earnings, PE ratios often signal these opportunities. Practically, Lisa could start by screening for stocks with low PE ratios, say under 15, using free tools like Yahoo Finance. She'd look at sectors like retail or energy, often overlooked during tech booms. It's not about timing the market but recognizing when a stock's price doesn't reflect its potential. The mindset shift is key: patience. Unlike day trading, value investing rewards those who wait, sometimes years, for the market to wake up. It's less about flash and more about conviction in your analysis. How to identify undervalued stocks. Finding undervalued stocks is like detective work. You piece together clues to spot mismatches. Start with financial metrics. P/E ratio compares a stock's price to its earnings per share. A low PE, like 10 versus an industry average of 20, might signal a bargain. Price-to-book (P/B) ratio is another. If a company's market value is less than its assets worth, it's potentially undervalued. Take Juan, a 40-year-old nurse with a side hustle, who wants to invest $2,000. He uses a screener on Finviz to filter stocks with PE under 12 and PE below 1.5. He finds a retailer hit hard by a bad quarter but with strong cash reserve. Digging deeper, he checks its debt-to-equity ratio. Under 1 is ideal, showing the company isn't drowning in loans. Beyond numbers, qualitative factors matter. Is the company in a temporary slump, like a carmaker during a chip shortage, but with a loyal customer base? Annual reports and earnings calls reveal these stories. Juan listens to a CEO's plan to pivot, boosting his confidence. Tools like Morningstar or Seeking Alpha offer analyst insights, but don't blindly follow, cross-check. In 2022, stocks like CVS Health traded at PE ratios half their sector's average, later rebounding 20% in a year. Juan's research could uncover similar plays, blending data with intuition for a calculated bet. Analyzing a company's fundamentals. To know if a stock's truly undervalued, you need to dissect its fundamentals like a chef breaking down a recipe. Start with revenue and earnings growth. Consistent increases over 3 to 5 years signal stability. Check cash flow. Positive free cash flow means the company can reinvest or weather storms. For example, consider Priya, a 29-year-old tech worker eyeing a small bank stock. She pulls its 10K report from the SEC's website, noting steady loan growth but a recent dip from rising interest rate. She calculates its return on equity, ROE, 15% versus an industry 10%, showing efficient profit generation. Competitive advantage, or moat, is crucial. Does the company have unique strengths, like a patented product or brand loyalty? Coca-Cola's a classic. Its brand keeps it dominant despite market swings. Priya sees the bank's regional dominance as its moat, serving communities big banks ignore. Risks matter too. High debt or legal troubles can sink a stock. In 2019, General Electric looked cheap but was bogged down by debt. Value investors who ignored this got burned. Priya avoids such traps by setting clear criteria: ROE above 10%, debt to equity below 1, and a clear recovery path. Building a margin of safety. The margin of safety is your buffer against being wrong. It's buying a stock so cheap that even if things go south, you're protected. Graham taught this. Estimate a company's intrinsic value, say, based on future cash flows, then buy at a 30 to 50% discount. For instance, Mark, a 35-year-old teacher, estimates a manufacturing company's intrinsic value at $80 per share using a discounted cash flow calculator online. It's trading at $50. That $30 gap is his margin of safety. If his math's off or the market lags, he's still likely to profit when the price rises. How to calculate intrinsic value. Simplified, take projected earnings, apply a conservative growth rate, say 5%, and discount to present value. Free tools like Guru Focus help. Mark also checks the company's history. Has it weathered recessions? A 2008 survivor with low debt boosts confidence. This approach isn't foolproof. Markets can stay irrational longer than you can stay solvent. But historically, value stocks with strong margins of safety, like those in the Russell 1000 Value Index, have outperformed, returning 11.5% annually from 2000 to 2020. It's about stacking odds in your favor. When to buy and sell. Timing isn't about predicting market dips, it's about discipline. Buy when a stock's undervalued relative to your analysis, not because it's cheap. Sell when it hits your estimated intrinsic value or fundamentals weaken, like declining profits or management scandals. Take Sarah, a 38-year-old entrepreneur. She buys a utility stock at $20, estimating its value at $35. 2 years later, it hits $34, and she sells, pocketing a 70% gain. Alternatively, she notices its debt spiking, red flag. She exits early to protect capital. Patience is critical. Value stocks can stay undervalued for months, even years. Data from Dimensional Fund Advisors shows value stocks often take 3 to 5 years to realize gains. Sarah uses alerts on her brokerage app to track price targets, avoiding impulsive moves. Avoid emotional traps. Don't hold a loser hoping for a rebound if fundamentals erode. In 2020, some clung to airline stocks despite structural issues, missing better opportunities. Set clear rules. Sell if fundamentals shift 20% worse than expected. Diversifying your value portfolio. Diversification spreads risk, ensuring one bad pick doesn't sink you. Aim for 10 to 20 stocks across sectors. Think healthcare, consumer goods, tech. Over-diversifying dilutes returns, but too few risks disaster. For example, Tom, a 27-year-old mechanic, builds a portfolio with 12 value stocks, a mix of banks, retailers, and industrials. When tech crashes, his banks hold steady, balancing losses. He uses ETFs like VTV, Vanguard Value, for instant diversification, adding individual picks for upside. Allocation matters. 20% per sector max prevents overexposure. Rebalance yearly. Sell outperformers, buy laggards if fundamentals hold. From 2010 to 2020, diversified value portfolios outperformed concentrated ones by 2% annually, per Morningstar. Tom uses free portfolio trackers like Personal Capital to monitor. This approach feels empowering, blending control with safety. Avoiding common pitfalls. Value investing isn't a golden ticket. Mistakes can sting. First, avoid value traps, stocks that look cheap but are dying businesses. Think Blockbuster in 2010. Check growth trends. Stagnant revenue is a warning. Don't chase hype. A stock dropping 50% isn't automatically a buy, investigate why. In 2021, some bought meme stocks without fundamentals, losing big. Always validate with metrics like PUE or cash flow. Overconfidence is another trap. Assuming you've cracked the code can lead to skipping research. Even Buffett misjudged IBM in the 2010s. Stay humble, double-check assumptions. Finally, don't ignore macro trends. Rising rates can hurt value stocks like utilities. Stay informed via news or X posts for real-time sentiment. A disciplined checklist, metrics, moat, margin, keeps you grounded. Monitoring and adjusting your strategy. Value investing requires occasional tune-ups, not obsession. Review quarterly. Are your stocks still undervalued? Have fundamentals shifted? Use apps like TradingView for alerts on price or news. Adjust if needed, say, a company's debt balloons or a sector sours. In 2022, rising rates hit real estate stocks. Smart investors pivoted to energy. Rebalance to maintain diversification, selling overvalued stocks. Track performance against benchmarks like the S&P 500 Value Index. If lagging consistently, reassess your criteria. A 30-year-old freelancer, Mia, logs her picks in a spreadsheet, noting why she bought and sold. This clarity sharpens her edge over time. Stay informed but don't overreact to noise. X posts can highlight market sentiment but verify with data. This balance keeps your strategy sharp yet steady. Value investing is your chance to buy tomorrow's winners at today's discount. We've covered spotting undervalued stocks with metrics like PE and P/B, analyzing fundamentals, building a margin of safety, and staying disciplined with buys, sells, and diversification. Avoid traps, monitor smartly, and act now. Start researching one stock today to kickstart your journey to long-term wealth. Check out the description or the first pinned comment for links to free tools and exclusive tips to get you started. And since you're here, YouTube's picked the perfect next video for you. It's on screen now, so keep learning,